Welcome to AllGen's Market Update. My name is Jason Martin. Today is September 15th, 2020. Wanted to give you a update, not so much on all the markets, but I want to focus in today on a lot of tech and growth stocks and a lot of the similarities we're seeing right now between between now and the late 1990s. And then I want to give a warning out there to all the day traders and short-term traders, a lot of which have just started doing it recently. And then I want to talk about the little bit of pockets of value that we're seeing out there that is some potential. So this is a chart of the Nasdaq, and we're looking here from basically 1991 to 2000, and then from 2000 at this top right here, all the way down to 2000, late 2002. So there was an astronomical boom in technology stocks. And by the way, the Nasdaq is mostly made up of large growth companies that are mostly tech and biotech type of stocks. So, but you can see here in the late 90s, just an astronomical, rise in the market that brought the Nasdaq up 1,250% during that time, but then proceeded to drop 77% afterwards, a huge drop in the market, specifically in the Nasdaq during that big bubble. So, and then just kind of looking at that. That was looking at the last tech bubble in the late 90s. Now we're looking at 2009, basically the March low of 2009, all the way up until now. And so the Nasdaq rallied from its low point all the way up to its recent high point, 850%. So not quite as much as the late 90s, but still an astronomical rise. And with that type of rise, a lot of risk starts to develop, specifically within the tech stocks and the large growth stocks. So during the late 90s too, you had some amazing stocks that kind of led the way. It made some pretty amazing rallies and percentage rises. So this is Amazon. Amazon went up 7,400%. In a 3-year period from 97 to 2000, but then proceeded to drop almost 95%. So a lot of people don't realize, how much Amazon dropped, and just tech stocks in general dropped after that major run in the late 90s. So, and another similarity from now till the late 90s is that you have these stocks. Like this is an example. This is a company called Nikola. Nikola has been really famous recently because they have these concept cars, actually trucks, that are battery powered electric vehicles for semi trucks, for kind of like ATVs, jet skis, and just bigger pickup trucks. Cool idea and great concept, and there may be some success, but what's interesting is that this stock has almost no revenue, like less than $1 million in revenue, and it rallied 672%, bringing it up to $80 a share. But when it got up to $80 a share, the market value, meaning the value of that company with its share price, was larger than Ford. Okay, so Ford with like $80 billion in revenue plus for the year, versus this stock who has less than $1 million in revenue, and this stock was valued greater than Ford. So and Ford's been around 100 years. So that's just something that is very similar to the 90s. I remember it's actually when I started in the business, but in the late 90s, you had stocks that had zero revenues, but then all of a sudden they put a .com behind their name, and their stock price would just explode. And so, you're having a lot of these scenarios where these kind of unknown stocks with hardly any revenue are just going up and reaching market caps that are just you can't justify by its actual fundamentals. So another similarity is the current valuation. So the current valuation of the stock market is up to a forward PE of about 22 times. It actually got up to that a week ago. And back in the late 90s, it got up as high as around 24. And the so that was one of the most overvalued times in the market, and this is as well. So we're not quite at those highs, but very close to it. Anytime you have valuations this high, it definitely raises the level of risk. So this is an interesting chart, and this gets a little bit technical, but there's been a massive surge in risk trading among the smallest of traders. And as we've kind of gone over through other market updates, is that when kind of your smaller traders, maybe people are just starting out, and they're starting to trade. They it's more kind of a hobby. They don't have really any experience. They're not a professional. They're just kind of going off a whim. They're listening to news, and that's where they get their stock buying ideas. Those types of people. Now, what those types of investors or traders will kind of do once they kind of get the think they got the hang of trading stocks, a lot of times they'll go to the next level and start trading options. So, and just simple buying a call option or buying a put option. A call option is betting on the upside of the market. A put option is betting on the downside of the market. So, as you can see, this scale right here, the amount of people buying the amount of small traders buying those speculative options has reached actually levels higher than in 2000, and that was a very similar time frame. A very similar thing that now versus then is that you had people for the first time ever day trading because you had companies like E-Trade and Scottrade and a lot of these companies coming out back in the late 90s that allowed people to invest on their own for the first time, and it formed a lot of day traders, a lot of option traders, and that thought they were geniuses and thought they were going to make a ton of money. So now, at the same time, you also have a massive surge, or this chart also shows the massive surge in risk trading, but this is the amount of people betting on the upside versus betting on the downside. So it's basically your put to call premium. But it's looking at it from the standpoint of when a lot of people bet on the upside and they buy a lot of calls, simple supply demand, when there's a lot of demand, it raises the price of those calls. Versus the amount of people that are betting on the downside, which is not very many, then the premium or the cost of that option is a lot less. So to sum up what this chart is looking at is it's meaning that a lot more people, that it's becoming a lot more expensive to bet on the upside because a lot of people are betting the upside and very few people are betting on the downside. Specifically the smaller traders, and these are charts by Sentiment Trader, but what Sentiment Trader calls dumb money, people that are kind of not in the know, that are just kind of trading off a whim, that are going off the news, that type of stuff. So now, looking at this chart, all these red dots in the past are all the times that we've reached this level. But I want to kind of focus in here on what happened in the late 90s, kind of early 2000s, how many people were betting on the upside versus the downside. And that was right before that big drop, especially in the Nasdaq during that time. So, any time the market has done this over the last 20 years, on average, the market's gone down about 7% a year later. Now, just to disclose, I took these charts as of August 28. That was right before the market dropped, especially the tech stocks recently dropped. But I thought it was interesting that 67% of the time when this happened, 6 months later, the market was down. And on average, it was down about 4%. And about 61% of the time, the market was down a year later, and on average down about 7.7%. So now there's also another similarity is that in the late 90s, you had a very few amount of stocks that was leading the entire market. So what happens is, because like the S&P 500, the S&P 500 is market weighted, when a stock like Amazon becomes a lot bigger and Apple becomes a lot bigger, it becomes a greater weighting of that index. And so it only takes those kind of few stocks that are the largest of them all to pull the indices higher. So it's usually a bad sign in the market when there's only a few companies leading the market higher and a lot of the other stocks are kind of left out of that move. So what this looks at is how many days in a row has the stock market made new highs, but while less than 65% of the stocks are above their 200-day moving average. So that means they're not participating in the market going up, and at the same time, less than 10% at 52-week highs. So very few companies are actually making new highs, even though the stock market is making new highs. The point of this is that there's just a few stocks that are kind of leading this market higher. A lot of people heard of the FANG stocks, kind of Facebook, Apple, Amazon, Netflix, those type of stocks, Google. But those are the ones that are kind of leading the market higher, similar to the late 90s when you kind of had the Ciscos and the AOLs and the Amazons and the Microsofts leading the market higher, but the rest of the market really wasn't participating. So that's another similarity. Now, what I want to show you here is look at the difference between then what this is looking at is looking at year to date. Okay, this is the different size of the companies: large cap, mid cap, small cap, and this is the different styles of money management: value, blend, and growth. Now the Nasdaq and these tech stocks that are going up would be considered growth. Okay, large cap growth. So since the March 2009 low, large cap growth is up 743%. Large value, which would typically be like your Procter & Gamble's, your Walmart's, your Johnson & Johnson's, those types of stocks are only up 375%. The smaller value stocks are only up 318%. Look at this year to date. Large cap growth is up 22.9, values down 9.9. Almost a 40% difference. Well, 33. At one point, recently, it was almost a 40% difference between large growth and large value this year. Unprecedented amount. Very rarely has that ever happened in history. If you even look at the difference between large growth and small cap value, it's even worse, or even a bigger difference. Now, the kind of the novice trader would be, okay, well, why don't we put more money in growth? That's the one that's going up higher, but that's kind of like, Paul usually makes this reference of trying to drive by looking at the rear view mirror. And that's not a very good idea, because that's already happened, okay? And when stocks have gone up a lot, there's a big chance that those types of stocks can now go down going forward. And at the same time, the stocks that haven't done as well, a lot of times the money will flow out of that which has done really well and gone into the areas that haven't done so well. So what this chart looks at is a 40-year history of kind of growth versus value, but it's looking at 1970 to 2010. And you can see during that time, this line right here, which is small value, averaged 15% during that time. So on the previous screen I just showed you, that was the worst area recently. And the best area recently was large growth. You can see over that same time period, 1970 to 2010, large growth was the worst time period, going up 7.6% instead of 15%. Now, one thing I want you to kind of key in here, and I got another slide to show you this, is look what happened in the late 90s, how large cap growth, this light blue area right here, how much that went up, and it started to almost take the lead. It was going up greater than any other area. But then look what happened when the market fell in 2000 through 2002. It went down the most. Now look at kind of small value during that same time, a little bit more of a steadier pace, and actually during the late 90s, in the late 90s, it went down slightly, but then once the market started falling from 2000 to 2002, that area started going up. And so now, just focusing on that time period, 1997 through 2003, this chart looks at growth, which is in purple, and value, which is in orange. So similar here in that in the late 90s, large growth really started to do better than value. But at the same time, when growth started to fall in 2000 through 2003, value actually held up really well during that time. And then sometimes, actually, if you looked at only small value, which this is large and small value went up during that time frame. And so, even though you had large cap growth go up so much and value not go up as much during that big rise, for that whole time period, up market, down market, come on the other side, value actually did better. So my point is this, you have to be really careful. You have to be really careful trying to invest in the areas that are going up a lot right now, especially if they've already made a huge percentage move to the upside. Even though it's not as sexy or not as exciting, you have to kind of look at what are the areas that haven't done so well recently, and is there a good potential they could rebound. So our portfolios right now tend to lean a lot more value, and now we're trying to stay away from some of that large cap growth, especially now that it's gone up as high as it has. So in order to protect our clients. And what I'm also trying to say is, even if large cap growth stocks fall and some of those tech stocks fall a lot, there is still the opportunity for other areas of the market to continue to go up, like value stocks. All right, so now, my warning to the day traders and the short-term traders out there, a lot of similarities between the late 1990s and now. A lot of people taking up day trading and stock option buying for the first time ever. Here's some statistics for you. 90% of people who day trade lose money, which means there's a very high failure rate. One of the highest failure rates of any strategy out there. So, and the other thing is, a lot of people become addicted, and it becomes like a drug to them, and they have to do it, and they're glued to their screens, and they're trading all the time, and it can be very unhealthy. And it also, in order to be an excellent day trader, which I don't advise, you have to spend a lot of time focused on the different charts and all the different things that are happening in the market, which, if that's not your primary job, it's taking you away from doing your primary job. So that's not a good thing, and it really can have an effect on relationships. I've seen, in the late 90s, I've seen a lot of people get divorced because of this type of stuff, and we never want to see that for any of our clients. We also don't want to see you lose a lot of money. And some of the worst things that can happen is when you start to make a lot of money initially, and that happened to me. When in the late 90s, when I started trading for the first time, when I got into the business, I did do some day trading. I traded options. I did all the things that I now advise people not to do. I made a lot of money for a 22-year-old during that time. In a very short time period, which made me think I was a genius, which was very naive, because I ended up losing everything from that 2000 through 2002 time period. And I was doing everything I advise people not to do right now. I'm grateful for it, because it taught me all the things not to do. But I dedicated a lot of time and effort into it, and it's a very difficult thing to do and to be successful at. So I'm just warning everyone out there, be very careful. I would advise not doing it at all. If you are going to do it with the amount of money that you're okay losing all of it, okay? Would not use that portion of your money to kind of plan for your retirement. All right, so sum it all up. Tech and large cap growth stocks have increased significantly in a high risk zone, so we're being careful to avoid those. Also, one last warning to avoid day trading. But while the large cap growth and tech stocks have gone up a lot, we also believe there are some pockets out there, like value, that are not as overvalued and have the potential to go up, even if the large cap growth stocks drop a lot. So, hope this helps, and hope to see you soon. If you haven't done so already, click here to subscribe. We frequently upload market update videos on the coronavirus, provide financial planning tips, and relevant personal finance topics on our channel.